Call it what you want, Bitcoin's firmly in a downtrend. Despite the fact the SPX is basically at all-time highs, the Nasdaq's 2% away, silver just printed a new all-time high this week. So what is going on? Why is crypto so decoupled from the rest of the markets? I'm going to go into exactly why I think crypto and Bitcoin are going to remain pressured to the downside and when this can possibly turn around. This video is for information and entertainment only. It reflects my personal opinions and is not financial advice. Check the description for more information. Always do your own research. Hey guys, I'm Alessandro. Welcome back to the show. Look, everyone keeps referencing this chart here to say, look, the PMI is going to turn around, but they're failing to recognize why that is. Why is this chart suddenly going to turn around? If you don't know what this is the Purchasers Manufacturing Index, which just explains whether or not companies were growing or contracting last month. It's a very simple survey that's sent out to companies, and it basically asks them, did you buy more stuff than last month? Did you hire more than last month? Did you sell more than last month? If they say, yes, we did more, they get a score of greater than 50. If they say, no, we did less, they get a score of less than 50. It's a very simple, very effective measure of the economy at large in the US. And actually, what you can see is that throughout this entire cycle, the PMI has been contracting. It's been underneath this baseline of 50. 50 is considered to be the line in the sand. Greater than 50, that company was expanding. Less than 50, that company was contracting. Obviously, then it's extrapolated out for all the companies inside the survey. What you normally see is that PMI peaks are met with Bitcoin peaks. PMI peaked here, Bitcoin peaked here, PMI peaked here, Bitcoin peaked here, etc. But this time, there's this big discrepancy between the PMI and Bitcoin price action, suggesting that potentially when this PMI does turn around, there's going to be a big catch-up trade and Bitcoin can expand, or crypto can expand underneath a true business cycle. I completely agree. Couldn't agree more. But expecting the PMI to just suddenly expand because it's been down has been wrong this entire cycle, which is why alts have been struggling so much. There was a new PMI print last week, 48.2. Another month of contraction. That's not very good. And what you can see here is that new orders and employment inside this survey have both been under 50. What does that mean? It means that on average, companies made less orders than last month. On average, companies employed less people than last month. And this is pretty damning, right? Chicago is often considered as a barometer for the rest of the US market. A lot of trade goes through Chicago, so oftentimes Chicago is seen as one of the leading indicators for the US PMI at large. What happens to Chicago tends to happen to the rest of the US afterwards. And Chicago printed a 36 last month. And just read this. No respondents reported larger employment levels in November. Not one company that filled out this report increased the amount of people employed in their firm. That's mental. I mean, that's just like a statistical anomaly. But it just goes to show the US labor market right now is definitely struggling. And this struggle in the labor market is clear to see across all of the US. In November, private payrolls were down 32,000 jobs. Small businesses reported big job cuts. You can see that in this very obvious line chart here. Since basically the middle of last year, we've been in a downtrend in terms of total numbers of jobs, right? This is total employment in the private sector, down, 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 down. It's now negative, right? Last month we had a read of minus 32,000. We were expecting 10,000 to be gained. So a big amount of layoffs, basically. Across the year, a Challenger report came out last week, and it announced that 1.1 million jobs were lost in the last year. Obviously, AI is a big contributor to this, the most since 2020. Maybe this shouldn't be a surprise because obviously as AI gets better and better, more people are going to lose their job. This is almost a guarantee, but these things are starting to show up in the data. And what does this tell you, right? People are losing jobs whilst stocks are ripping up higher. It tells you that there's a two-tiered economy. Very, very simply, the K-shaped economy, one portion of the economy is getting better, one portion of the economy is getting worse. Asset owners are gaining wealth. People who have to trade their time for money are losing wealth. This chart here shows you the difference between hard data and soft data. Hard data is things like GDP, things that are numerically based. Soft data is things like the ISM PMI, things that are subjective in their nature. And it shows you a very, very clear pattern, right? The economy appears strong while sentiment across households and businesses is deteriorating. And this is again highlighted by the fact that the US stock market is more concentrated than ever. The market cap weight of the top 10% of the largest stocks in the US now make up 80-ish% of the entire index, higher than before the Great Depression, higher than the dot-com boom. Doesn't mean it's going to have to blow up anytime soon. It just means that, look, things are getting very concentrated. Some people are winning big. A lot of people are losing small. And then there's this as well. This is kind of interesting. It's kind of funny, to be honest. The Russell 2000 is an index of smaller companies in the US. These companies can be split between the profitable Russell, so the companies in the Russell that make money, and those that don't make money. The profitable Russell companies are up 10% this year. The unprofitable Russell companies are up 45% this year. Morgan Stanley has a basket for each of these, and you can see here, right? This is the profitable companies in the Russell, up 9% for the year. This is the unprofitable companies in the Russell, up 44.5% this year. This just clearly shows you that the vast majority of gains come from speculation. As soon as you put numbers on revenue, suddenly your numbers don't look that good anymore. There's no ability to grow into numbers. There's no expectation of results. There's just the actual results. And again, this sort of like ties back into that K-shaped economy, the poor getting poorer, the rich getting richer kind of thing, because which companies are actually turning a profit? The companies that are probably turning a profit are those more mum and pop kind of companies. They're not growth tech companies that can trade at multiples, the sort of industries that are arguably getting outdated. And so we've got layoffs increasing, whilst the vast majority of companies are not doing great because they're not really expanding, whilst the companies that are seen to be doing the best, the ones that people want to speculate on, are ones that are not profitable. Not only that, the data the Federal Reserve are going off of is often wrong. So this is a survey of payrolls, so how many people they had employed basically. And what it tells you is that, look, these employment numbers were stated higher and revised down. Stated higher, revised down. Stated higher, revised down. Takes into account these numbers and then makes interest rate decisions upon how many people are employed alongside inflation. In the last 4 months, we've seen big revisions downwards, even to negative readings. The data is clearly saying that the labour market is struggling and it needs some help. 𝗕𝗘𝗦𝗧, who's known as the Fed Whisperer, wrote a post quite recently saying that, look, even if we get a brand new super dovish Fed chair, it doesn't necessarily mean there's going to be rate cuts immediately, because the Fed chair is like a quarterback. He still needs the team around him to be more dovish. But fundamentally, they're going to need to reduce rates, knowing that reducing rates into this environment is going to push up inflation. But all of this bad data basically says, look, the Fed are going to have to reduce rates. This is a chart that shows the short-term treasury yield, which often dictates what the Fed funds rate ends up being. So the direction this chart moves shows you where the Fed funds rate is likely to go next. And I want you to take special attention here, because reducing rates pre-2008 didn't necessarily mean number go up straight away. In 2000, dot-com boom, rates were reduced to stimulate the economy. The NASDAQ still came down. Again here, rates were reduced. Markets still came down from the place they were reduced from to the bottom. Now, if we go up here, since 2008, since the global financial crisis, actually rate reductions have been met with increases in the NASDAQ, and rate increases have been met with drops in the NASDAQ. As you can see here, this run has happened in a rate environment that's been largely flat. Yes, it's trending down now, and likely it's going to continue to trend down. We're likely getting cuts into an expanding economy, and it just needs Bitcoin to catch up. And this is where it all sort of comes together. We've got a crazy backdrop where you've got rates reducing, a dovish Fed chair, liquidity likely coming into the markets very soon, and the business cycle hasn't really begun yet. I wouldn't be surprised to see more pain in the short term, followed by a rip to the upside that truly is backed up by an expanding economy. But I think the key to watch is to expand. Unless we start to see this figure here start to come above the 50 line, we're going to really struggle to see true expansion across the broader economy. We're probably going to see concentrated expansion still in those top tech companies, especially. If that stops, it's going to be a big problem for the rest of the market, no doubt. But unless we can see this PMI trend upwards, we're probably going to remain under pressure. And this PMI is likely to stay compressed. We can keep an eye on the Chicago print. We can keep an eye on the monthly print. These come out every single month. We can keep an eye on what the Fed are doing as they're reducing rates too. But very likely, the Fed need to do 2 or 3 more cuts to truly bring rates down low enough for the economy to start expanding. 2 or 3 more cuts likely puts us out in the middle of June or so next year. That's what the probabilities suggest right now. Markets might kind of front run that, but I would not be surprised at all to see more pain for crypto right now, despite the fact everybody's been calling for a reversal because QT has stopped. Massive shout out to 𝗵𝗘𝗫𝗧 as well for sponsoring today's video. 𝗵𝗘𝗫𝗧 are exchange that have basically any token you'd ever want to trade on there. But what I really like about 𝗵𝗘𝗫𝗧 is I can get this card that I can then just go and spend. If you've been in crypto for any amount of time, you'll know how annoying it is trying to get your money from being on chain to a bank account. It's painful, it takes a long time, it's laborious, it's annoying. Being able to spend money on chain essentially is incredibly convenient. That's why I really like this 𝗵𝗘𝗫𝗧 card, where any funds you have in 𝗵𝗘𝗫𝗧 can be easily spent using this card. It makes life super simple. Investments in blockchain involve risks. Prices can go up or down. Don't invest unless you're prepared to lose all of your money. Crypto is a high risk investment, and if anything goes wrong, you shouldn't expect anybody to come and save you. But the last time QT ended, it didn't turn markets around immediately. It required intervention from the Fed because something blew up for that liquidity injection you can see here. QT ended, Bitcoin came down. It wasn't until there was this giant injection of liquidity that we saw Bitcoin begin to rally. In actual fact, in 2019, there's a big blow up in the repo market before COVID even happened. So QT last time caused liquidity shortages, which basically meant the Fed had to turn the money printers back on. There is a chance something like that can happen. These two charts here both show you right now there's liquidity shortages. The Fed's repo support shows you there's liquidity shortages, and the secured overnight financing rate minus the interest on reserves also shows you there's liquidity shortages. What these two things show you is, look, generally they should be trading around about the zero line. These should be trading underneath the zero line. When they're not, there's a problem. And if they stay above it for too long, sometimes things can go very, very wrong. And obviously the Fed has been pulling liquidity out of the system via quantitative tightening for quite a long time now. Maybe there's going to be something that blows up soon. And so what am I actually doing? Well, I think we come up and we retest the underside of this 50-week moving average at least. I don't think we hold it. I think we get rejected. I'm perfectly happy to flip my bias around if we close above this swing high here. In fact, I'll probably flip my bias around if we close and hold above the 50-week first, but really this swing high here is a key line in the sand. There are a bunch of levels that I think need to come and be taken out. First of all, there's this USDT level up here, which is about 20% away from current price action at about 7%. USDT going up is bearish for all of crypto. I think ETH BTC needs to come back down to either this level or this level, 15 to 22%. I think ETH is going to come down to one of these two levels. And again, another key level. There's a bunch of liquidity here that probably needs to get taken out. I think total 2 comes down to at least this level here. Again, a bunch of liquidity that needs to get taken out. And I think total 3 minus stablecoins comes down to this level here. Again, a bunch of liquidity that probably needs to get taken out. If I start to see confluence on all of these things, very, very good sign that a big reversal is likely going to happen. But for the time being, I'm just sitting on my hands really. I've got long-term positions that I really, really like. I bought some Bitcoin at 95K. I bought some Bitcoin at 90K. I bought some more Bitcoin at 85 and 80K. I'm happy now. If price comes lower, I'm going to buy some more. So obviously some of those buys are underwater. It's completely fine. But I think all this kind of coincides into sort of like one time that sufficiently wrecks the most amount of people. I think we're going to last just long enough to the downside. I think we're not going to go quite low enough to suffice the bears, so that the true bear market cyclists think that we're going to go super low. I think that's going to sufficiently wreck them too. This kind of coincides as well with the Fed chair being switched around, with liquidity freshly coming into the markets. You know, middle of next year, maybe being the time at which things can really, really begin to take off. I think we can be under pressure, continue down for months and still turn around at some point. It's very tempting to feel like you always need to have a position on, but actually having no position is a position in and of itself. And actually no position is categorically not the worst position either. But anyway, guys, that covers it for today. Thank you very much for watching. Please give the video a like. Also, please, if you can, go check out the latest Risk Takers show, because this is actually a wicked show that I did with Ran a few weeks ago. Really, really cool insight to kind of who Ran is, what motivates him. It was awesome fun recording it. If you like it, leave a comment, leave a like, share it with a friend. Otherwise, I hope you have an excellent day. Thank you ever so much for watching. I'll see you in the next one. Today's sponsor is EasyBitcoin. EasyBitcoin operate a recurring purchase service for Bitcoin. The service functions through scheduled car payments at user-defined intervals. So if you wanted to buy $1 a day, $10 a month, you get to choose the amount and the interval that you want to DCA. Upon processing payment, the company purchase Bitcoin and transfer it to a user-specified address. This service operates on a non-custodial basis, meaning purchased Bitcoin is sent directly to the user-controlled wallet without ever being held on any platform. So there's no third-party intermediary risk. EasyBitcoin is not available in the UK. This information is provided for education purposes only and does not constitute financial advice or a recommendation. Cryptocurrencies can carry significant risks, including loss of capital. Thank you very much to EasyBitcoin for sponsoring this portion of the show.